Hey everybody, today we talk the psychology of trading and investing, because the psychology has to do with timing. It's easy to get emotionally manipulated. Oh, I have to get in, there's something going on, let me jump in. That's the FOMO, fear of missing out. And then there is the greed. Oh no, let's stay in here, we might triple from here, we might 5x from here. That's greed. So we will look at timing and we will look at emotions from a psychology perspective. This video is about the cycles. So the psychology, the mathematics, the biology and the geometry of trading. And the next video is then about two specific emotions, fear and greed, and how to get to an emotion-free investment system. Because you will need an investment system. Either you are a trader or a long-term investor, doesn't matter. You need a system that helps you take emotions out of the game. Otherwise, you will just lose money. And you will also burn out, like most traders do, because it's too emotionally involving. It's too exciting to be in that risk all the time and to be pulled by emotions all the time. So on our way to create an investment system that fits you, this is the next step, the psychology of trading. This is important. We have to understand cycles and we have to understand timing. So the cycles, it's really important to understand the Elliot Waves. These are typical cycles that the market endure and that the prices endure, and they are quite reliable. They are used since hundreds of years, and they are quite reliable in showing you in which part of the cycle we are. And everything that moves up will come down eventually. So a typical Elliot wave has a set of 5 movements, and inside those movements there are the movements. From a psychology perspective, you see this here being 1, 2, 3, 4, 5, right? And then there is the reduction, and then there is 1, 2, 3, 4, 5, and there is the reduction. So the impulse wave up to 5 never has a 6. At 5 it's over and the cycle goes down, and then it starts again. That's the cyclical nature of all things, and also the markets, because markets are made of people and emotions. And the pros, they enter exactly at 2. This is where the pros enter, hedge funds. They do it for a living. They're also called the smart money because they get that moment right for multiple reasons. Insider information, market manipulation. But the important thing for you to know is they get it right, you usually don't. So we retail investors, we come in much later. We don't even know what's going on at that moment in time. So the pros enter, we are at 2. Then institutions enter. Then the funds enter. And then we enter. Okay, so usually we are too late. We've missed the first big leg up, and we are now trying to catch a train that is already running. We're trying to catch the 4 to 5 movement, and hopefully we get it at the beginning. Then at least we have some of the upward movement that we have collected. Otherwise, we just get in late and are ready to get burnt on the downside from 5 to the next correction, which is what usually happens. So retail usually comes in too late, buys at the top, gets frustrated down, buys the dip, runs out of money, and then they capitulate and go, oh my God, no, I'm not gonna do this trading thing again. And so this is how the typical retail psychology. So you come in too late, then it moves down, then your friends tell you to buy the dip, you buy the dip, you run out of money. Because markets are irrational, and they can stay irrational much longer than you can stay liquid. That's why buying the dip is not per se a strategy, not in every part of the cycle. We have to understand in which part of the cycle we are, because buy the dip can be a good thing if you are between 2 and 3. So in the uptrend, it's a good idea to buy the dip. But it's not a good idea between 5 and the next. So this is the psychology of trading. Be aware that you are usually too late and that the whole game is manipulated towards that. Okay? It's not even your fault, it's systemic, it's embedded in the thing. That's the psychology in terms of timing being too late and then having this feeling that you should jump in. Whenever you see this feeling, I should jump in, you are probably already too late. So don't buy if you have this feeling. Better to position yourself by doing fundamental analysis and technical analysis that you can study in those videos that are named that way. And then position yourself so when the wave comes, you have already accumulated enough assets that the wave raises you with the water. Okay, all waters raise, and also your boats get raised by the same water. What if your business would run well even when you are on vacation? Discover how 1,600 business owners have regained their freedom using the Strategy Sprints blueprints. How they enjoy living their dream and watching their business scale. Get the exact checklists they use to go from stressed to fulfilled using the Strategy Sprints method. Order your copy of Strategy Sprints 12 Ways to Accelerate Growth for an Agile Business on Amazon today. And if you love it, leave us a review. For more information, head over to strategysprints.com. Second thing to look at is what I call the biology of trading, because there are recursion levels inside of each wave. Same wave as before, 1, 2, 3, 4, 5, and then down correction ABC. So the same wave that you see on the big picture, 1 to 5, in each wave there is a fractal, which means the same wave on the recursion level below. Recursion level is a term from biology. If you look at a tree, biology is resilient and has survived tens of thousands of years because it is built in fractals. So if you look at a tree, the same structure of the tree is the structure in the parts of the tree. And that's why it is resilient. It doesn't need to reorganize, it just lets some parts drop and they will grow again. That's the fractal principle. And so as you can see here, in each of those cycles, the sub-cycle has the same structure. So you can look at it at the first recursion level. If you are an investor, you just look at the big cycle. That's what I do. That's why I don't even look at the candles, green and red candles. I look at the general trend because I'm an investor. But then if you're a trader, you have to look at the substructure. And if you're trading on an hourly basis, then you look at the substructure of the substructure, because that's the granularity that you need. So you have to decide which wave you surf. These are the waves, and you decide which one to surf. Next thing, let's call it the mathematics of trading, is that there are some entry points that are better than others. And so the 2 is the best entry point. That's why when we talked about indicators, we talked about 3 things, right? The RSI, Relative Strength Index, the Bollinger Bands, and the trend line. So when the trend goes up and you can get the long leg trend, you have the lowest risk and the maximum exposure to the upside volatility. So I marked the 3 entry points because this would be the ideal entry points. Now, everything else, don't try even to trade it. If you are a retail investor, somebody who does this part-time, just look for these 3 entry points, and you don't have to nail them perfectly. You won't. If you just use half an hour per day, you won't nail them anyways. But you can try to get that big leg and ignore the rest. So you save time and you're quite efficient in just getting some uptrends, and that's enough to grow a portfolio. Later on, when you get more acquainted and you decide to spend more time per day, then you can get fancy and start studying the single geometry of trading. There is the impulse wave 1 to 5, and there is never a 6. There is always ABC down. So the impulse wave, you know it's coming down. The flat wave is usually an accumulation period, which is before the next leg up. The diagonal looks like it's going up, but it will probably break down. When we say probably, this is not a hard science. The diagonal is not even 80% reliable. So, and also the triangle, they are not reliable. Sometimes it's true, but not always. And the triangle would break up upwards, and then there is the zigzag. So these are fancy things you can look at later on, and there are a ton of books and resources where you can study more of it. But for now, the most important things are to look at your feeling. If you feel like, ooh, I'm late, I should jump in, check in which part of the cycle you are. You're probably too late. This is how most people lose money, if they still have emotions. So the next video is going to be about the emotion of fear and greed, and we zoom even more in how you can make your system emotions free, so that you stay longer in the game and increase wealth instead of losing money. Let me know what you need next, and keep rolling. If you want the how-to guide on running a resilient and agile business, get the book Strategy Sprints, 12 Ways to Accelerate Growth for an Agile Business. It offers the step-by-step blueprints to elevating your marketing and sales. Order your copy of Strategy Sprints, 12 Ways to Accelerate Growth for an Agile Business on Amazon today. If you love it, leave us a review. For more information, head over to strategysprints.com.